The U.S. national debt has exploded higher and now is over $31 trillion.
U.S. debt is ticking up. In fact,
the country has officially hit the $31.4 trillion debt ceiling.
Republicans and Democrats must raise the $31.4 trillion debt limit by this summer or risk defaulting on debt payments.
And this incredible debt problem could take the United States straight into the inflation danger zone. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the system, how dollars were created, not just in the United States, but outside of the United States prior to the GFC. To understand what will happen in the future regarding inflation, we have to understand how the currency units that are definitely a component of consumer price inflation were created in the past. All right, we start with a chart of global GDP. This goes all the way back to 1960, 2019. On the left, we go from 0 trillion up to $90 trillion. This blue line represents world GDP, global GDP. The green line, United States, and the red line, the amount of dollar-denominated bank reserves that were held at the Fed for the U.S. banks. Why am I getting U.S.-centric? Because it gives you an idea of the balance sheet capacity for the U.S. domestic banks that was being used to create dollars prior to the GFC. All right, let's go through this. First and foremost, I want you to understand that 60 to 70% of global transactions are settled in dollars, going all the way back to Bretton Woods when the dollar became the global reserve currency. So now let's go right back to the chart and focus on world GDP. Pretty much flat lines. I mean, it's going up, but this isn't a log chart. 1970, it really starts to go up significantly. And then from 1980 to 2000, it goes up at a very steep rate. But my goodness, from 2000 to 2010, it goes pretty much parabolic. It skyrockets all the way up to almost $70 trillion. At the same time, the US economy went from maybe 8 up to, call it 15 or 20. The main thing I want you to take away from this chart is this huge gap, this delta between the blue line and the green line. And understand that this blue line going up, especially to this degree, requires a large amount of dollars because such a high percentage of global trade is settled in the USD. So you may be asking yourself, okay, George, I get it, but what's your point? The point is there were a lot of dollars that were created outside of the US domestic system. And let's remember, we've got an economy that's, let's say, $70 trillion. And just with the United States banks, they only have 40 billion with a B, bank reserves. So how on earth could the United States commercial banks themselves backstop this entire $70 trillion system? The answer, they couldn't. And insert the next key component here, which is the Eurodollar system. This is a network of banks outside of the United States that since pretty much the 1950s have been creating their own dollars without the Federal Reserve. These are dollars that are created with no reserves that back them up and no cash, no green pieces of paper. So you may be scratching your head and saying, okay, George, well, how on earth does that work? All right, we got Bank A, we got Bank B. Actually pretty simple. Got the balance sheets, assets on the left, liabilities on the right. Bank B needs dollars, dollar liquidity. So they say, hey, Bank A, I need a loan. Bank A says, okay, I know you. You're my buddy. There's very low counterparty risk in the system. All things go. We'll go ahead and give you that loan. So A creates the dollars out of nowhere and gives them to B. And then B, basically the asset A gets, is that loan that they now have on their balance sheet. So after the transaction, and let's assume for a moment that B has an account with A. After the transaction, here's how the balance sheets look. We've got Bank A has that asset, that loan they just created, and the liability is the dollars, the Eurodollar deposit that was just created for Bank B. And on Bank B's balance sheet, their assets are those newly created Eurodollars. The liability is the loan, the money they now owe Bank A. So my point with step number one is to illustrate how this system created trillions and trillions of dollars outside of the United States without the help of the good old Federal Reserve and the central bank. And the oil that made this engine work was simply trust. That's what made the whole system go around and function properly. So, in other words, we have perceived counterparty risk. How much trust is in the system? Because if this bank trusts that bank and they know they're going to make a profit, why wouldn't they do the loan? They don't even need collateral. So if we have very low perceived counterparty risk, the demand for collateral very low, but the supply for collateral very high. Why? Because there's actually a collateral multiplier. We're going to talk about this throughout the rest of the video, where if there's very low perceived counterparty risk, the primary dealers, the financial institutions that have a lot of these treasuries, let's say, they will lend them out to multiple parties to use as collateral. So just to make sure we're on the same page, one treasury can be used for collateral 10, 20, even 30 times, assuming the perceived counterparty risk is very low, which takes our story straight into the global financial crisis. Step number two, in 2008, the world and the global monetary system changed forever.
Let's talk about the speed with which we are watching this market deteriorate.
The NASDAQ, everything and more has been completely wiped out.
Many banks have restricted lending.
They are facing crisis. Their stocks have plunged, and they are banks.
Lehman Brothers is going bankrupt.
It was the worst day on Wall Street since the crash of 1987.
So let's go into why the world almost came to an end in 2008, and then how the system changed and why that will likely lead the United States straight into the inflation danger zone. The key goes right back to the global monetary system, and it was incredibly fragile. Why? Because it was built on one thing and one thing only. That was trust. So when the trust collapses, so does the global economic house of cards. Let's go right over to the whiteboard. Let me give you a visual as to what happens. It's actually pretty easy. Prior, going back to step number one, we know that it was built on trust, and if we did need some collateral, we had treasuries and mortgage-backed securities. Enter everyone's favorite toxic sludge into the story. But this circle represents, let's say, the total collateral available for this global monetary system or the Eurodollar system. But what happened is when the GFC hit, everyone recognized these banks in this network said, whoa, we're not going to take those mortgage-backed securities anymore, and the counterparty risk is going through the roof. The trust is going down. So we need collateral. We need a lot more collateral, but now the system only has treasuries. So the amount of collateral available went from, let's say, this much straight down to that much almost overnight. And this is one of the main reasons why we had the GFC. If it wasn't for this phenomenon, and if it wasn't for the fact that the Eurodollar system or the global monetary system was so fragile to begin with, it most likely would have just been a real estate crash. It would have been contained to those countries where the real estate got up to nosebleed levels. It wouldn't have been a global financial crisis. So once the trust evaporates and the amount of collateral basically gets sliced in half, what happened? Well, Ben Bernanke came to the rescue, everyone's favorite central banker. And here he's holding a sign that says, use my BS. And I'll let you decide what BS stands for. In the case of this video, we'll just assume that it's balance sheet. So he's saying, hey, we've got the Federal Reserve here. We're going to go ahead and use our balance sheet to backstop the entire system. And you can see this happening right here on our chart. Remember, this chart is not just global GDP, but also this red line indicates the bank reserves that were on the balance sheets of the U.S. domestic banks. So quantitative easing, we all remember that. Remember QE1, 2, 3? Now it's pretty much infinity. Although they're trying to do QT, more on that in just a moment. But right here we did QE1, QE2, then QE3, and then we were starting to do QT into 2019. We know that reverse course with the cerveza sickness. But my point here is Ben Bernanke took the amount of reserves on the Fed's balance sheet, and he took them from 40 billion straight up to 2.7 trillion. Now, I know a lot of you watching this video right now are going to say, oh, George, that's 10 trillion. You're not even close to accurate on your stupid drawing. Yeah, I get that. But if I only brought it up that much, you wouldn't even be able to see it. So just forget the left-hand side right now. Just focus on that. We went from 40 billion straight up to 2.7 trillion. And this indicates what Bernanke was doing. He's going to the global monetary system and saying, hey, we realize that now you're short on collateral. Now the trust has evaporated. So go ahead and use my BS to backstop the system. So perceived counterparty risk goes straight up. The technical term for this, in case you didn't know, is mucho risk. So we get mucho risk in the system, and therefore the demand for collateral goes up, but the supply goes down. And it looks something like this. We go from that much to this much, then we take this much and add it to the Fed's balance sheet, and that was the Band-Aid. That was the spit and duct tape that patched up the system, in my opinion, temporarily, after the world almost came to an end in 2008. But unfortunately now the system is even more fragile, more unstable, especially if you remove the Federal Reserve from the equation. And as you can imagine, this is when the problems really begin. So sit down, pour yourself that stiff drink, because you're going to need it for the rest of this video. Step number 3. Now let's talk about how the United States debt will most likely continue to explode higher and how this could take us straight into the inflation danger zone for the rest of the 2020s. So in step number 1, we talked about how the system prior to the GFC, really no Fed, not too much collateral, because the perceived counterparty risk, very low. Then we went to a system that was backed up by the Fed. We needed a lot of collateral because perceived counterparty risk definitely went up. That was post GFC. But now we've gone into a whole new world, a new type of system. Because let's remember, Jerome Powell is over here, obviously Jerome Powell, and he's holding a sign saying, I'm doing quantitative tightening, which is the exact opposite of quantitative easing. Where before they've got their balance sheet backstopping this Eurodollar system. Now they're doing the exact opposite. They're taking their balance sheet out of the equation. So what's the new world that we're moving into? It's where there's no Federal Reserve, and this assumes that Jerome Powell continues with quantitative tightening. And we need more collateral, because if you don't have the backstop of the Fed, that void has to be filled with something. And most likely that will be filled by US Treasuries, or that pristine collateral. So let's go back to this example. We got Bank A, Bank B, and Bank B needs some dollar liquidity or an extension of credit, dollars, a loan, however you want to phrase it, from Bank A. So Bank A says, okay, we need those treasuries. So Bank B has those treasuries on their balance sheet. But if they didn't have those treasuries, they couldn't get the dollar liquidity they need. So if there's no Fed there to backstop Bank B, they're going to need a lot more treasuries moving forward in order to get the dollar liquidity they need. Oh, but wait, there is more. In this type of environment, what is happening to perceived counterparty risk? You've got this system that since the GFC has been built on the Fed's balance sheet and collateral. So now we're removing the Fed's balance sheet. So perceived counterparty risk will most likely continue to go up. And if that goes up, then the amount of collateral or demand for collateral goes up, like we were saying over here, but the supply of collateral goes down because those primary dealers or those financial institutions are a lot less likely to rehypothecate the treasuries they have to use as multiple forms of collateral. Now let's go ahead and think this through in terms of government deficit spending and how this may impact inflation, create more currency units in the United States economy, chasing the same amount of goods and services. So right now, when your drunk, insolvent Uncle Sam issues treasuries, usually the buyer is the average Joe or business XYZ, we'll say a non-bank entity in the real economy. So those dollars go to the government. They go into the TGA, the Treasury General Account, and then Janet Yellen will take those dollars and spend them back into the economy. So what's happening here as far as the balance sheets, average Joe, business XYZ is trading dollars for treasuries. Okay, that makes sense. But on net balance, has the amount of dollars or currency units in the real economy gone up or down? Trick question. Neither. On net balance, it's a wash because the dollars are going out of the bank account of the non-bank entities and then just going right back into the economy. But when we move forward and the euro-dollar system needs more and more and more of these treasuries, what will happen is they will come in and be a significant buyer and maybe outbid the average Joe and the non-bank entity here in the domestic economy, which we have seen has been the major buyer over the last couple of years. But this puts the government in a very difficult position, almost a Triffin's Dilemma 2.0. And most of you know from watching my videos, the original Triffin's Dilemma, or Triffin's Paradox back in 1844, when the United States had the world reserve currency, is Triffin came in and said, wait a minute, this is probably going to not end well because the United States is now responsible for supplying the world with all the dollars it needs to grow and function on all 8 cylinders. But if the United States does that, they're going to have to run massive trade deficits, which will hollow out their manufacturing base and do other things that might be counterproductive for the United States economy. So you have to choose. On one hand, you've got the US domestic economy, and on the other hand, you've got the global economy. And what we did is we built a system where the United States just subcontracted out all of the manufacturing that they were getting rid of based on having to export all of those dollars through bigger and bigger trade deficits. But now all of a sudden, the United States government might be in the exact same position. This time not with dollars, but with treasuries. So, like I said, they've got to make a choice. Either they continue to create more and more and more and more treasuries, which is what the global system demands, or they could tighten their belt, do what's right for the domestic economy, but then the global system implodes. And you may be saying to yourself, okay, George, well, that's a good choice. I prefer, as an American, that we focus and prioritize the US domestic economy. But not so fast. You have to understand that now the United States domestic economy is completely dependent on the global economy. So we can't let it implode. So we're between a rock and a hard place where the government might have to deficit spend to greater and greater degrees in order to give the global system the collateral it needs to avoid imploding. And you say to yourself, okay, George, I get that, but what does that have to do with inflation? All right, so in this case, dollars go in, dollars go out, net balance, it's a wash. But if the euro-dollar system, all these foreign buyers come in, they give the euro dollars. So these are dollars that exist outside of the United States. So those dollars come into the government, then those treasuries go out into the system for collateral. But then when Janet Yellen spends those dollars into the system, because they're coming in from offshore, it's going to be a net increase to the domestic economy. In other words, more currency units denominated in dollars chasing the same amount of goods and services. So it could take us right into this very bizarre situation where the United States CPI is continuing to go up. In other words, the dollar is losing value against goods and services in the United States, while at the same time, the dollar is gaining value against fiat currencies outside of the US domestic economy. This is why the United States debt will most likely increase into the future and how it could take us straight into the inflation danger zone. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.